How does it go? You get what you pay for? Well, investing's no different. Paying lower fees can come at a cost. At Fidelity Investments, we know that missing out on financial advice can also be costly. Independent research has shown that over time, working with a financial advisor can create 2.3 times more wealth than those who go it alone. That's right, up to 2.3 times more. So ask your advisor for Fidelity. It's how you can get ahead and stay ahead.
Hello, everybody. Welcome. My name is Dave Bushell. I'm head of advisor distribution here at Fidelity, and welcome to all of you to the Upside. As always, a fantastic show today, but I'm going to say a very important show as well. And today we're going to be talking about the importance of financial advice, the importance of working with an independent financial advisor. As the ad just showed, how important can this be? Well, according to our research, 2.3 times wealthier. I think we all agree that's very, very important. Now, here at Fidelity, we are huge believers in working with independent financial advisors from across Canada. If you take this call we're doing today as a perfect case study, all of us tuning in today are different. We have different ages, different risk tolerances, different family situations. All of us will require a slightly different financial plan. This again goes back to our strong belief that working with independent financial advisors from across Canada can drastically increase the financial health of Canadians. Now, we have a big topic. Obviously, there's lots to unbundle here, and I have two wonderful guests that are going to help me with this topic. First, we're joined by Michelle Monroe. She is the Director of Tax and Retirement here at Fidelity. We're also joined by Andrew Klee. He is our VP of Product here at Fidelity. Michelle, Andrew, thank you both so much for joining us today.
Thanks, Dave. It's a pleasure to be here.
Thanks for having me again, Dave.
Thank you both. Now, just before, I'm going to start with Michelle, but just before I do that, we always try and make these sessions interactive. Q&A button should be on the right-hand side of your screen, so please use that button throughout our show today and get your questions sent in. So, Michelle, a big topic here. I know it's something that you're very passionate about, and I know that you, I'll say it, in the old world, spent your time traveling across Canada, coast to coast. Now you Zoom across Canada, and you work with advisors, working with their clients. You really have seen so much of the power of, again, working with a financial advisor. Can you walk us through some of the things you've seen and how this really comes to life?
Yeah, thanks a lot, Dave. You know, the main benefit of working with a financial advisor, it's hard to distill it down to one thing. So you think about, well, you're looking at a relationship between a financial advisor and their client. And it's a long-term relationship. And sometimes I like to describe it as a financial partnership, or the advisor is acting as a financial coach to their clients and really helping them achieve their long-term financial goals. And when people think about that, well, the first thing that pops into mind is you're thinking about, well, it's retirement planning. And well, even within you go into retirement planning, well, there's two phases, the accumulation phase and the decumulation phase. And then the financial advisor, the financial coach, is providing more information about, well, it's not just the products, the investments, the money management. It's, well, tax efficient products. Are you putting those products into the right accounts? So looking for tax efficiency. And then what goes hand in hand with that is tax planning, and cash flow, debt management goes along with that as well. And when you think about financial goals, it's not just retirement goals. It's also thinking about, well, post-secondary education. My oldest is going off to university in the fall, and I've been planning for that for years to help with that. And it may not just be children's post-secondary, it could be grandchildren's post-secondary as well. And as well as thinking of this as a topic that comes up again and again, is thinking about estate planning or charitable giving, which forms all of legacy planning. And as I'm talking here, Dave, it's also this is long-term stuff. How many people do we have on the call? 457. There's a lot of people. So we're going to have a lot of different demographics. Some of those people could be in their 20s and 30s, And retirement planning, well, that could be 30, 40 years in the future. Or we could have some early retirees, and life expectancy could be 20, 30 years into the future. So we're looking at long periods of time. And then when you add on to the taxation planning, tax efficient products, it sort of becomes really mind-boggling. It becomes very complex. And what happens is people become overwhelmed with it all. And this is where a financial advisor can really provide some additional assistance, as they take that big complex plan, making it bite-sized. What could we be doing today, this week, this month, this year to achieve those financial goals, not just retirement planning, but beyond? So I guess if it's going to distill, I've been talking a long time here of the three things. Well, you're creating a plan, a long-term plan. You're building in tax strategies, tax efficient planning. You're talking about cash flows, estate planning. You're thinking about accumulation and decumulation. And the advisor is really working as an accountability partner to help their clients stay on track to achieve those long-term goals.
Thanks, Michelle. Those are some great points there. I was wondering if I could ask you a quick follow-up question. I think it's interesting you talk about a daughter going off to school, but there's so many life events for everybody. Some positive, someone going off to school, but there's sadly death, there's marriage, there's divorce, there's all of these things. How important is this? I know you've used the word in the past, this is a living document. So how important is it that this document is sort of refreshed, updated? What are your thoughts on that?
Yeah, so we're going to create a plan with our financial advisor. And it's not something that is one and done and you throw it into a drawer and forget about it and maybe dust it off. It's something you should be reviewing annually at a minimum. I review my plan 3 times a year. I do it at the start of the year because it's fresh. You begin when I do my tax return in April and September. That always seems like a good place to look at it again. So, but it's a living document that you're reviewing continuously.
I wanted to ask you another question, Michelle. Now, obviously, in my intro to you, I said in the old days, you would be across Canada. Obviously, we're doing this over Zoom with COVID. And we do hear these very horrible stories of people sadly being admitted to the hospital. Loved ones are not allowed through hospital regulations to see them and to be with them. What I always think of is, my goodness, what if people need to get their affairs in order? What if things aren't up to date? Could you maybe speak to perhaps how this pandemic has really shone a light on the importance of having these things done?
Right. And the pandemic has amplified a lot of things that existed prior to the pandemic, but it's highlighted it in a way that we're forced in a way to have to deal with it. And you're talking about, end of life discussions, and easier if you'd had these discussions a year ago, 10 years ago. But the next best time is to be doing that today. And a financial advisor can certainly, they've seen this thousands of times in thousands of different ways. And what they can be doing is making these conversations so much easier to create that plan, and introducing their clients to lawyers, accountants, estate planners who can really help them create a good plan to help achieve those. This is a tailored approach for those goals that they want to do for the end of life and whatnot.
Thanks, Michelle. Yeah, something definitely to think about. Andrew, can we switch gears to you now? Andrew, you and I have had countless conversations about I'll say the thinking or the emotions that go into investing. And I don't know if there's a more emotional part of your life than perhaps investing. And can you just walk us through, I'll call it behavioral finance, or your experience in watching this?
Sure, Dave. So I think this all comes back to my favorite quote in university or any CFA textbook is that all investors are rational. So that's an assumption that we boldly make, that everyone's acting on the same information. There is no information asymmetry. We all make the best decision in our best interests at the right time. And I can tell you, I made an irrational decision last week in trusting the Maple Leafs to bang out 7 wins against the Canadians. So it's completely irrational to assume that assumption holds when we look at stock markets. And so just to put it in context, if the market was rational and every investor behaved accordingly, there should be no alpha opportunity. So we look at a fund like Special Situations, long track record. It's almost doubled that of the stock market over the last 10 years, net of fees. Those opportunities simply wouldn't exist if the markets were completely rational and efficient. So I think there's a lot of evidence. And then we look at psychology merging with finance over the last decade or so. Tons of information's coming out of it, our biases that cause us to act irrationally in the market. So one example would be loss aversion, and this comes out of the casino and a lot of research done there. But there's a lot of evidence that investors hate losing money almost twice as much as they like making money. So we go back to March 2020, we saw the largest outflows of the industry possibly in history. And I know we saw it at Fidelity as well, on essentially the bottom of the market. It was at March 16th to March 17th. We were seeing outflows across the industry on a wide scale. And then that marked the bottom of the market. And we also see it in terms of investors being too conservatively positioned. So the fear of losing money means a ton of cash on the sidelines. And we saw that through much of this bull market. It was probably one of the most hated bull markets that we've ever seen in terms of the past decade or two. And now we see money coming in at higher valuations. So the risk of it is you act irrationally, you pull your money out at the worst time, but then you're also putting it back in. And there's a lot of evidence that if you miss the 10 best days in the market, that can significantly detract from your total return. So this is where I find the value in financial advice. And Michelle was talking about it, financial partnership, financial coaching. I almost view it as therapy as well, where I get on the phone with my financial advisor and just bounce the idea of, hey, I'm really worried about this, I'm thinking about selling it. And then they come with the less emotionally attached view and tend to talk me a little bit off the ledge in scenarios like that.
Andrew, you touched on a few interesting points. I want to drill it. And I was thinking of it this morning. We always use the analogy, my neighbor's in this hot stock. And now that it's warm, we're actually speaking to our neighbors again, because we're at least going into our backyards, hopefully. So we're now hearing the stories. And if we look at even the last 12 months, we had a big boom, and I'll call them weed and pot stocks. Big boom. There's crypto has obviously been stealing the headlines recently. I'm sure there'll be one after this. So how much does I call it the neighbor effect play in that, my neighbor made X on this stock? How does that also play into, I'll call it perhaps the fear of missing out, the new, the FOMO, I've been told is how I'm supposed to pronounce that. How does that all bake into this?
Well, yeah, the dinner table stocks are always fascinating because I'm sure your neighbors never told you about how much money they lost on something like Nortel back in the early 2000s. It's always about the winners, so you need to take it with a grain of salt. And the second thing I think Michelle touched on earlier is the revisiting of your investment objectives and your risk tolerance and time horizons. So everyone's situation is unique. And I think the objectives, so your financial goals, as long as the time horizon that you have really dictate the type of stocks that you should be buying. So I remember infamously, I was at a conference and an investor said, I don't need dividend stocks for income and retirement. I can buy stocks that only go up, and I can sell them down at gains to fund my income needs. And capital gains are more efficient than the dividend tax treatment. And I remember thinking to myself, well, that's an incredibly impressive story because one, you're claiming that you can only pick stocks that only go up. And two, I doubt that they've gone through a bear market and experienced having to sell down stocks that are at incredibly attractive valuations to fund income needs. So I was thinking about that investor last March when we saw the equity market chop down 33%, and you're a forced seller to meet income generation. So I think that's a prime example where the advisor sets what your objectives are. If you're an income needing investor, you're probably not looking at something like a pot stock or a cryptocurrency, which is incredibly volatile, but also doesn't pay out an income stream. Whereas if you're a young investor that's saving for retirement, you have a long investment horizon. And this is where you do have the opportunity to go after some of those growthier or higher expectation stocks, just because these can play out over decades, not months. And I think that was pretty evidenced when we saw Bitcoin fall about 33% in a single day. It has bounced back a fair bit, but that volatility profile doesn't fit every investor objective or risk tolerance.
Andrew, I'd love for you to just perhaps expand a little bit on something you just mentioned, and that's risk tolerance, which is obviously we all love to make money. Everyone on this line today loves that. Nobody likes to lose, but how important is it? And maybe Michelle, I get you to weigh in after Andrew on constantly having that conversation as risk tolerance change, because I do think there's recency bias in someone's risk tolerance. And I mean, Andrew, I laughed that you mentioned Nortel. I remember that vividly. How important is it that we have these sort of brought back to the forefront of our mind when we're thinking about our risk? Maybe I'll get you to start, Andrew, and Michelle, I'd love for you to comment as well.
Sure. So recency bias is largely that we expect recent events to continue. So when you're going through a rosy bull market, or the cryptocurrency is making its way from 30,000 to 60,000, you just get comfortable with that exposure. And the important thing is to remember is that if something's going straight up, that means it's becoming a larger part of your portfolio. And that's where it's very prudent to start looking at your risk tolerances, because if I buy something at 2% and then everything else in my portfolio is flat, but that stock's up, let's call it 1,000%, all of a sudden I'm now looking at a scenario where that stock or that asset now representing nearly a fifth of my assets. And that's where an advisor can say, oh, this is getting out of our risk tolerance, because that's fairly risky. What used to be 1/20th of my portfolio maybe is now 1/5 of my portfolio, whatever that looks like. And that's where they step in and sell down your winners, buy your losers. We call that rebalancing. But what that allows us to do is bring our risk tolerance back in line, and then leave us in a situation that if something does terrible or like 33% drop, we're not caught offside and doing permanent damage to our portfolio. So I think that's a huge aspect of revisiting the risk tolerance within your portfolio.
Thanks, Andrew. And Michelle, would you add anything to that?
Yeah, I thought that was a really great summary that Andrew pulled together. And one of the things you think, well, the risk, typically what goes along with the risk is a potential for a higher return. And it's not a straight line between low risk, low return, and high risk, potential higher return. It's a curved line. And it's working with your financial advisor to figure out, well, where do you belong on that line? And it's usually a balance of a balanced type of portfolio. And it's something that you're reviewing continuously, how markets change, but also where you are in that life cycle as being an investor. Certainly a young investor is willing to take on more risk because they have time on their side. And you think historically, someone who moved into retirement would go into low risk products and lower potential, more fixed income type returns. But that strategy isn't going to work in today's environment because, well, longevity, people are living longer and longer, and we're in such a low interest rate environment. And again, putting these pieces together, talking with a financial advisor, financial coach, that financial partner, if you will, and figuring out, well, what is the best decision in my own specific situation, your specific situation, which will be different. And then you're making informed, educated decisions, which are the best decisions for you.
Thanks, Michelle. I'm going to actually hit pause here for a second because we've gotten a lot of interesting questions in, and I think it's important that I just clarify for everybody how Fidelity works with independent financial advisors. So just so everyone knows, the way that it works here in Canada is Fidelity works with the independent financial advisors from across Canada. So when you're working with your independent advisor, obviously we hope that you ask them about Fidelity and that they're recommending Fidelity to you. And again, if you're tuning into this call today and you have any additional questions about Fidelity, we encourage you to reach out to your independent financial advisor and ask them for their opinions and their guidance. So just to level set that. So Michelle, I'd like to come back to you with a quick question. You've talked a lot about a pivot plan and plans changing. And I see you get smile when you say this. I know it's a topic that you're very passionate about. Could I get you just to explain to everybody today, what do you mean by what is a pivot plan?
Okay. So in my first intro there, I talked about the importance of having a plan to achieve your long-term financial goals. And then you know what? Life happens. It throws you a curveball. It knocks you on your backside, and you need to pivot. So you need to pivot your plan. And you know, some of those curveballs, they could be small, they could be big ones. They impact you in various ways. Financial, maybe people have lost a job, big expenses. It could be social, think separation, divorce, a death of a loved one. It could be health-wise. lots of health concerns. And certainly, as we talk about, we're navigating the pandemic. This is a global health pivot, if you will, which has impacted people as well as socially. We're all doing these Zoom calls now, as well as a lot of people have been impacted financially. And we're on to 15 months of this now. And at certain times, it could be acute stress for people. But for a lot of people, what it is it's constant low grade stress. And what that means is it becomes there's mental and emotional exhaustion. And what does that mean when it comes to finances and investing? Well, people are tired. And this is where a financial advisor can be helping, providing rational, thoughtful, informed decisions. And when you're in a pivot situation, well, this is, if you have a plan already and you're going to pivot that plan, well, it's probably some small tweaks, some minor changes. And if you don't have a plan, well, a financial advisor could be helping people there too, because they're going to create a plan, helping people really stay on track to achieve their goals. And we've done research here where people, when they have a written financial plan, not only do they feel better prepared financially, which seems obvious, but they also feel better emotionally, socially, and even physically. So it really comes around to all aspects of their life. They feel better prepared, having that written plan.
Very important. And I can definitely obviously see how that brings great peace of mind to Canadians. Thanks, Michelle.
Yeah.
Andrew, I wanted to go back to you. A very important question for you. We mentioned at the top of the show how our research shows us that working with an independent advisor can lead to 2.3 times wealth. There is contradictory math out there that refers to 30% wealthier without. Now, I know you and I have talked at length about this, but I'd love for you, for the audience today, to just unbundle that statement.
Sure, Dave. So I think the most important caveat that headline is likely missing is all else equal. So we hear about it in math, we hear about it in markets, textbooks across the world. But one of the largest things that they left out of that headline is the assumptions that were made in that study. So the first assumption is that they're going to match the return of a more expensive product. So they're looking at the average mutual fund return that exists in the Canadian marketplace today, and they're looking at the fees associated with it. And because they haven't been in market as long as the mutual fund industry in Canada, a lot of this is done hypothetically. So what they're saying is, if we could hypothetically match the return of the existing mutual fund, and we charge a lower fee than that existing mutual fund, then you could retire 30% wealthier. But as we know, and we pointed out at the top of the call, markets are not efficient. People don't behave rationally, and alpha opportunity exists. And that's what we do on a day-to-day basis. So we're not in the business of insurance. All we do day-to-day is manage money. We have thousands of investment professionals around the globe, and they're trying to find that information asymmetry. So find that edge in the market, meeting with management, uncover those alpha opportunities. So I think at the highest level, it's if we could match the return of a mutual fund like Fidelity's and charge a lower fee, then in theory, you could retire 30% wealthier. But as you pointed out earlier, just by having a financial plan and investment advice can result in 2.3 times greater wealth. So I think you need to consider the trade-offs that you're making for a lower fee product versus looking at something that's actively managed, have investment professionals behind it as a strategy and trying to uncover those hidden gems, as we would say.
And just another question, is it not also assuming that you're holding a product, I'll say forever or in perpetuity, and that your risk tolerance doesn't change? To Michelle's point, there are no life events or anything like that.
Yeah, and I think that's incredibly important, right? Because the lack of ability to chat with someone in a scenario like March 2020, we touched on that earlier. Flows tend to come out of the market at the worst time. They also tend to go back into the market at the worst time. So if you are just sitting at home on a computer and you're looking for advice through a chat robot or a contact us, an AI tool, that generally doesn't tend to end well when making those irrational decisions or potentially harming yourself by pulling money out at the worst time and missing some of that rebound that we saw through the month of April and May last year.
Very good points, Andrew. Thank you. So as we come to the top of the show, I have a final question for both of you, but Michelle, I'm going to go to you first. And that is, if you could really tie up today's program or summarize it in your words, what is the power of working with an independent financial advisor? Michelle, I mean, you have lots of experience in this. How would you really sum it up for everyone?
Okay, well, I would sum it up as thinking about, okay, what are my goals when it comes to financing and investing? And I think it would be across the board. People would agree. You want comfort, that you're financially secure in the future. And how do you, questions that you're asking yourself, you're thinking, well, where am I today? Where do I want to be in the future? Can I get there? How do I get there? And how do I stay on track to get there? And foundational to that is having a plan. And if you're working with a financial advisor, that plan's going to be pretty good. They're going to distill it into pieces that are achievable and helping you stay on track. And to me, that's a winning strategy.
Very well said, Michelle. Andrew, can we go to you for some final comments?
Sure. So I think the largest benefit is staying within the investment objectives and the risk tolerances. And a very wise investor once told me there's three trends in investing. They equated it to the ocean. So you have the ripples, you have the waves, and you have the tide. And when we talk about the dinner table stocks, those are largely the ripples. Then we talk about the value versus growth styles. That's the waves. They're shorter term in length. And then we have the tide. And what financial advice and investing with Fidelity Funds is, we're really trying to catch that tide. As long as we can get the larger picture right, that tends to end very, very well for investors in the long run. And I think that speaks to the studies that we see that you can retire 2.3 times wealthier. We tend to ignore the ripples and the waves, stick to our knitting, and try and catch those tides.
Wonderful comments. Thank you both very much for today. I thought that was a great conversation. I want to encourage everyone tuning in today, when chatting with your financial advisor, make sure you're asking about Fidelity and how the power of Fidelity can really be added to your portfolio. Just a couple of comments from me to close out. And I actually wrote down a couple interesting words here, which is, I've been talking about working with a financial advisor, but I've also heard financial coach, financial therapist, and financial partner. I'm sure we could probably add a handful more to that. So that would be a long email signature, but I think it's important that we've really chatted about all the different things and all the different ways, most importantly, that working with that independent advisor can help your financial health. Thank you very much, everybody. Again, thanks for tuning into The Upside. And just remember that if you're looking for more upside, please go on YouTube, search Fidelity Canada. Please subscribe and follow along to us. You can find the bulk of these programs reposted there. A very exciting program next week. We're going to be talking about sustainable investing. This is a big topic, only growing in popularity. So I encourage everybody to keep an eye out for that, and make sure that we welcome you back here next week for that topic. And as always, fidelity.ca, lots of great investor content on there also. Thank you very, very much for your time today. Keep well, enjoy the warm weather, and keep safe, everyone. Thank you.